Hey everyone, thanks for tuning in. Today's video will be about the Augusta Rule, what it's about, whether it applies to you, and how to execute that particular strategy to lower your tax burden at the end of each year. The Augusta Rule is from the 1970s. The rule originated from the Augusta golf tournament. Individuals who owned homes in Augusta, Georgia would rent out their homes during this time of year when the golf tournament was going on to individuals who were traveling in from out of town. The rule was built as an incentive for people to provide housing and not get burdened with the income tax that would accompany the income that they earn from rent while this golf tournament was going on. So keep in mind, the Augusta Rule is a way to not report income from rental properties as long as that rental property was rented for less than 14 days. Also, it's a way to not report any expenses associated with that property. So a big reason why the Augusta Rule is popular is because there's an accompanying tax strategy associated with it. This strategy relates to individuals who have businesses in addition to their primary or secondary residences. So what individuals will do is rent the living quarters or any room in their home out to a business for less than 14 days. So say if you're holding a retreat and you're going to the Bahamas and you've got property in the Bahamas, you can show this retreat, this say 5-day retreat in your home with your coworkers or your employees. You can have this retreat be deducted, the cost of this retreat be deducted on your business income, and concurrently you will avoid having to report the income from this retreat to your personal income taxes, right? So there's, if you will, not necessarily a trick or anything that's manipulating the system. It's simply you taking advantage of a rule that allows you to not report income on your personal level, but at the same time deduct rent expense on your business. So this rule applies to individuals with LLCs and S corporations specifically. The revenue code is clearly identifies as those two business types as the types you can use. This does not the revenue code isn't explicitly protecting partnerships and C corporations. So, if you're looking to take advantage of this rule, I recommend working with a tax advisor, preferably a certified CPA or EA, in advance before trying to execute the strategy. The reason I say that is because the strategy requires you to take detailed notes, usually minutes, or you have some sort of paper trail showing that you're actually making this payment from the business entity into a personal account or into some other type of account, and it's not just you transferring money from one bank account to another to reflect a business expense. Talk to an advisor, ask them about how to execute the strategy on the front end. This Augusta Rule strategy is not something that you can typically look at the end of the year and say, hey, I want to reduce my tax burden with it while preparing your taxes. Typically, if you aren't using the business side of the strategy and you've just got rental income, most tax preparers will ask you, oh, you have rental property. How many days was that rented? That's the number one way to determine whether you will need to include or exclude this property. Throughout the years, the Augusta Rule has been extended on a federal level and has been used by people who have primary residences that they are looking to rent out to travelers, or people who are who have vacation homes and secondary residences as well. What this rule is that if you are renting out property for 14 days or less, you can avoid reporting that income to the federal government and paying taxes on that income. Another part of the rule is that you are not allowed to report any expenses associated with this renting process of 14 days or less. So if you're paying for someone to clean up your home during that 14-day period, you cannot report the deduction on your income taxes. Neither can you report repairs and maintenance, lawn care associated with that 14-day window of tax-free income. Some other interesting tidbits to keep in mind with this particular section of the Internal Revenue Code, Section 280A, you can also claim business use of home while also excluding income that you are receiving from a business or your business that's using your home for less than 14 days. Also, keep in mind that 14-day threshold is very important. Once you go over 14 and you go into 15 days, all of the income, not just the income starting at the 15th day, suddenly becomes taxable. Keep in mind, this is a very, I've simplified a complex section of the revenue code. I recommend that you talk with an advisor before trying to execute it based on what I've told you. Not only is it complex, and not only are there specific nuances related to what qualifies as a primary and secondary residence, but the revenue code and how it's treated is always being changed. So talk to an advisor before executing this. As of this moment, court cases have not impacted the way this particular treatment of the code is being used, but that can change in a relatively short time period. So reach out to an advisor and get some help with this strategy before trying to execute it on your own.